Hey guys, welcome to Cash Flow and the 36 Other Financial Metrics. This is chapter 2, Assessing the Viability of a Real Estate Investment. Now, uncovering financial mysteries prior to purchase, revealing the reality behind the seller's discourse. Whether you're the owner of a suburban shopping mall or a duplex tucked around the corner, the fundamental principle of income generating properties remain consistent. The core idea is to generate revenue primarily through rent while also covering operating expenses and property related loans. By the end of the year, the aim is to have a surplus and to retain as much of it as possible. Minimizing tax liabilities, there's also the prospect of selling the property down the line for a substantial profit. In essence, the key objectives revolve around cash flow, appreciation, amortization, and tax benefits, the four fundamental returns. To attain these objectives as an investor, it's imperative to meticulously analyze the income, property, and expense data of any potential property acquisition. Similarly, when the time comes to sell, prospective buyers will scrutinize your financial figures to gain a realistic understanding of a property's potential value. Within this chapter, we delve into a comprehensive examination of the financial statement for real estate, commonly referred to as the Annual Property Operating Data (APOD). We explore how this data can function as a guide for evaluating property's performance and how it can help identify potential problematic areas. Foundational definitions. Let's embark on the exploration of income and expenses by revisiting some crucial concepts. Gross scheduled income represents the cumulative annual rental value of all units within the property. This encompasses both the actual rent collected from occupied units and the potential rent from vacant ones. Vacancy allowance is typically expressed as a percentage of the gross scheduled income. As the name suggests, it estimates the income loss due to vacancies. Some investors prefer to term this category as vacancy and credit loss. It also encompasses uncollectible rent. Gross operating income equates to the gross scheduled income minus the vacancy allowance. It also referred to as the effective gross income, essentially the amount you tangibly receive. Operating expenses encompasses elements like property insurance, taxes, repairs, utilities, and management fees. These expenses are necessary to sustain the income stream. Notably, mortgage payments and depreciation aren't considered operating expenses, no capital improvements. Net operating income (NOI) is calculated as gross operating income minus operating expenses. In simpler terms, it's what remains of your total potential income after deducting all vacancy and expense items. Mortgage payments and capital expenses don't impact NOI. Annual property operating data serves as the real estate equivalent of an income and expense statement. The terms APOD and income and expenses are used interchangeably. Utilizing these definitions, let's apply them to a practical property analysis. Imagine you're contemplating the acquisition of property A, a 4-unit rental apartment building. The current owner informs you that each apartment commands a monthly rent of $400 and their operating expenses for the previous year amounted to $5,200. You could structure this information in the following manner. Gross schedule income. Okay, let's actually switch to rands because I see now in this example I actually use dollars. We're switching it to rands. Gross schedule income 19,200, less vacancy allowance of 576, less gross operating income 18,624. No, it's actually equal to gross operating income. Now less operating expenses of 5,200 rand will leave you with a net operating income of 13,424. The gross scheduled income amounting to 9,000 to 19,200 corresponds to 4 units rented at 400 Rand per month for 12 months. The estimation of the vacancy allowance is practically a practical necessity, which you should ideally base on your understanding of prevailing market conditions and comparable properties in the locality. Guideline: when reliable market data is unavailable, many investors find it helpful to employ a vacancy allowance within a range of 3 to 6%. And notable exceptions to this guideline often arises in the context of newly constructed projects being leased for the first time. During the initial lease up phase, vacancies can be notably higher. Conventional wisdom also suggests that a property with minimal historical vacancy likely implies that it has been rented below market rates. Essentially, if you're not encountering some level of vacancy, you might be undercharging. By subtracting a 3% vacancy allowance from the gross scheduled income, the resulting gross operating income stands at 18,624. Deducting the operating expenses of 5,200 yields an NOI of 13,424. While these fundamental figures offer valuable insights, it's prudent to delve deeper into the property's operational aspects. Naturally, your next question would be, how exactly was the 5,200 Rand allocated? In response, the seller provides an itemized breakdown: 2,550 for fuel oil, 130 for electricity, 200 Rand for water, 250 for repairs, 1,270 for property taxes, and 800 Rand for fire and liability insurance. With this information, your annual property operating APOD data takes shape as follows: gross scheduled income 19,200, less a 3% vacancy allowance of 576, gross operating income of 18,624, less operating expenses: insurance 800, repairs 250, taxes 1,270. Now for the utilities: electricity 130, fuel oil 2,550, water 200 Rand, and the total operating expenses amounting to 5,200 Rand, where now the net operating income NOI is 13,424. You can enhance your comprehension of this property by taking an additional step. Recognize that the rent you actually gather, known as the gross operating income, is somewhat diminished by your operating costs. To gauge the extent of impact from each expense on your earnings, you can calculate the proportion of GOI that corresponds to each individual expense. This calculation is achieved by dividing each expense by the GOI, then multiplying by the outcome by 100. Gross scheduled income 19,200, less vacancy allowance of 3%, 576. Gross operating income 18,624, less operating expenses: insurance 800, which is 4.3%, repairs 250, which is 1.34%, taxes of 1,270, which is 6.82%, with the utilities being electricity 430, which is 0.7%. Fuel oil is 2,550, which is 13.69%. Water, which is 200 Rand, which is 1.07%, where the total operating expenses of 5,200 is amounting to 27.92%, and the net operating income 13,424. Now, examining comparable properties, basically just trying to compare different properties. It would be convenient if there were concrete and fixed guidelines to gauge this property against. For instance, a rule like heating costs should not exceed 11% of gross operating income (GOI), otherwise the building might require a new furnace. However, the absence of such neat and rigid rules doesn't imply a complete lack of guidelines. The real estate in this scenario isn't isolated. As potential buyer, you will inevitably inquire about how the operating statement of this property stacks up against that of other potential investments. You should indeed be one of your this should be indeed be one of your primary concerns, that you truly seek the capability to compare your data against some sort of benchmarks. While your expense percentages might not offer significant insights in an individual instance, they could provide valuable insights when juxtaposed with reasonable expectations. Where can you source these benchmarks? We explore several options in the preceding chapter. You could consult a real estate broker who is facilitating the sale of this property. They might have amassed data on comparable buildings in the vicinity, and you should be willing to provide you with the necessary information to make an educated purchasing decision. Another avenue is to engage with a property manager in the area, someone with first-hand familiarity with the operating costs of such properties. If you're fortunate, you might own the other property whose historical performance can guide you. At the very least, you can delve back into the market, inspect other current available properties, and analyze the operating statements of these competing properties vying for your investment. Let's consider properties B, C, D, each small multi-unit apartment buildings, along with property E, a compact commercial parcel featuring two stores and an office. Utilizing the same structure as the previous mentioned, you can create income and expense statements for each property. Now, let's start with property B. Gross schedule income of 29,000, less vacancy allowance of 3%, 870. Gross operating income of 28,130. Less expenses of insurance 2,650, which amounts to 4.3%. Repairs 800 Rand, which amounts to 1.34%. Less taxes, which is 1,575, which is 6.8%. Where the utilities are electricity, where you don't pay any electricity. Fuel oil 5,680, which is 13.69%. Water, which is 330 Rand, which is 1.07%, where the total operating expenses are 11,035, which are 39.29%. Then NOI, net operating income, being 17,095. Now property C. The gross schedule income of 16,800, less vacancy allowance of 3%, 504. Gross operating income is 16,296, less operating expenses, where the insurance is 800 Rand, is 4.1%. Oh, the lawn or grass, which is 250 Rand, which is 1.53%. Repairs of 1,000, which is 6.14%. Taxes of 1,157.06%. Where the utilities are electricity 450 Rand, which is 0.92%. Fuel oil, which is 2,600 Rand, which is 515.95%. Water is 180 Rand, 1.10%. Where the total operating expenses are 6,130, which amounts to 37.62%. The net operating income is now 10,166. Property D. The gross schedule income of 26,500 Rand, with less a 3% vacancy allowance of 795. Gross operating income of 25,705. Less operating expenses, advertising 95 Rand, 0.37%. Insurance 1,340, which is 5.21%. Grass 360, which is 1.4%. Repairs 1,875, which is 7.29%. Taxes 1,735, which is 6.75%. Trash removal or dustbins 150, which is 0.5%. Where the utilities are electricity 360, which is 1.4%. fuel oil 3,875, which is 15.07%. The gas is 300 rand, which is 1.17%. Water 720 rand, which is 2.8%. With the total operating expenses 10,810, which is 27.92%. The net operating income total is 14,895. Now property E. Gross schedule income of 16,800 rand, less vacancy allowance of 1,008, equals the gross operating income of 15,792, less operating expenses, where insurance is 1,100, which is 6.9%, repairs of 300, 1.9%, taxes of 1,250, which is 7.92%, utilities of 0, electricity 0, fuel oil 0, water 0, with a total operating expenses 2,650, which is 16.78%, with a total net operating income is 13,142. The most apparent distinction amongst these statements lies in the fact that the commercial parcel, property E, demonstrate the fewest expenses categories and the lowest total expense ratio. This outcome isn't surprising, given that it's quite common for a commercial property tenant to bear the responsibility for their utilities, interiors repairs, and sometimes even property tax increases. While advantageous for the landlord, it's essential to take note and thoroughly examine the lease associated with this property to ensure these costs are genuinely shouldered by the tenant rather than being obscured from visibility. It might be wise to allow for a larger vacancy allowance compared to residential properties, since an empty commercial space often takes longer to rent than an empty apartment. However, the critical point here is that the nature of this property significantly differs from the others being considered. Drawing inferences from a non-comparable property might lead to erroneous apples to oranges comparison, risking misleading assumptions about property A. While the commercial property might be valuable, it isn't an appropriate benchmark for evaluating property A. Shifting the focus from residential investments, it's essential to compare them with each other and with your initial proposition. Upon analyzing the operating statements for property A through D, several similarities and differences emerge in expense ratios. Similarities include insurance expenses range from 4 to 5% of the gross operating expenses for 3 of the 4 properties. The gross expenses are about 1.5% in 2 of the 4 properties. Repairs account for approximately 6 to 7% in 2 of the properties. All 4 properties indicate property taxes ranging from 5.5 to 7% of the gross operating income. Electricity costs are below 1.5 in 3 properties. Heating fuel expenses make up 13 to 16% of the gross operating income in 3 properties. Water costs fall between 1 and 1.5% in 3 properties. The total operating expenses range from 37 to 42% in 3 properties. Differences are apparent as each property exhibits inconsistent expense ratios in various categories. Additionally, certain expenses like grass, advertising, trash removal, and gas appear in limited instances across operating expense statements. How can this information be useful? The APOD form serves not just as a source of answers about investment property, but as the origin of crucial questions. By carefully examining it, you can unveil the most insightful inquiries about how a property expense currently operates and potential future functioning. Taking property B, which shows the highest gross operating income, as an example, you notice unusual expense percentages. Insurance and heating costs consume a large proportion of income, while repair costs represents a lower percentage. The absence of electricity costs is due to tenants having separate meters and paying for their usage. However, why are there entries of 130 Rand, 150 Rand, 360 Rands on other statements? Upon inquiring with each building owner, it's revealed that the electricity expense is for the separate meter common governing the common area lighting, such as hallways and entryways. This raises questions about why such an expense isn't listed in Property B. Is it an oversight, or is it a lack of a separate meter? In the latter is If the latter is true, could this expense violate local codes or ordinances necessitating correction as the new owner's expense? The higher insurance costs at Property B might indicate potential building code violations, prompting the necessity for an independent insurance court to assess insurability. An inspection by an insurance company could highlight violations affecting insurance coverage. Considering the condition of the heating system, verifying utility costs directly with suppliers is crucial. Higher costs, as seen here, warrant investigation into potential system issues or inefficiencies. A comprehensive inspection is vital to answer these inquiries. Lastly, the lower spending on repairs at Property B requires understanding. Exploring possible explanations is essential, demanding thorough investigation to ascertain the true cause or combination of factors. In summary, scrutinizing each property's unique expenses ratios provide valuable insight into their operational functionality. It prompts a series of vital inquiries and considerations necessary for making informed investment decisions. The next property didn't necessitate much maintenance this year. If the trend persists this year, it's unlikely to continue next year. The owner spent a significant sum maintaining the property this year. His expenses were so extraordinary that he feels it would be misleading not to provide the typical annual repair costs. This raises questions about potential hidden surprises. Although the owner spent the specified amount, it wasn't sufficient for proper building care. Investors term this deferred maintenance signifying negligence and impeding repair costs, delaying repair costs, escalates costs, and heightens the risk of management issues and income losses. Unusually low repair costs warrant scrutiny as much as excessive ones. Noting atypically expenditures leads to numerous investigative questions for further property consideration. An additional note, Property B's total operating expense amount to 39.29% of gross operating income, seemingly within typical range. However, delving into the breakdown of these expenses alerted to the potential problem areas. Shifting to Property C, no glaring red flags in expense percentages catch your attention, yet a new expense category grass surfaces. This emphasizes the importance of not only evaluating provided expense figures, but also considering misleading information. Essential questions revolve around future potential expenses beyond those reported. Property D, introducing advertising and trash removal expenses, prompting consideration of further expense categories beyond the previously analyzed ones. Additional scrutiny will occur when reconstructing Property A's income statement. Property D is unique in reporting gas expenses and significantly higher water bills. While deviations from norm requires explanation, not all deviations signal trouble. In this case, the increased water usage is due to appliances provided by the owner for tenant use. Returning to Property A, the focus will involve reconstructing the original operating statement to reflect realistic expectations over the next 12 months. The annual property operating data APOD form Understanding the and working with the APOD form, similar to what experienced investors utilize, is crucial. Utilize the provided form or a downloadable spreadsheet for detailed analysis, focusing on necessary rows for calculation. Reviews Review the property's operating statement with the same crucial perspective applied to properties B through D. Gross operating scheduled income 19,200, gross income of 19,200, less vacancy allowance of 576, which amounts to 3%, um, equals to gross operating income of 18,624, which is 97%, where the expenses are insurance 800, 4.3%, three repairs 1,117, which is 6%, taxes 1,270, which is 6.8%, utilities are electricity 280 rand, which is 1.5%, fuel oil, which is 22,900, which amounts to 15.57%, water is 200, which amounts to 1.07%, total operating expense, which is 6,976, 6,567, which amounts to 35.26%, where the net operating income is 12,057, 64.74. Upon scrutinizing the expenses, the insurance costs seem consistent with the other properties, but it's advisable to obtain a quote from your own agent. Taxes also appear typical, and a quick call to the assessor's office can determine if any of the changes are anticipated soon. It's crucial to remember that a revaluation or tax rate can impact the next year. Even if last year's figures are accurate, fuel oil costs align with the lower end of the typical range confirmed by the seller. Oil dealer based on deliverable gallons or liters prevailing oil rates. However, the electricity cost of this property is notably lower than in most other buildings, without a clear explanation from the owner. From the reconstructed analysis, an estimated adjustment to align with the expected 1.5 of gross income or 280 rand is suggested. The most significant deviation from the norm is evident in the repair category. Although the owner appears well maintained, the property appears well maintained. The expense of 1.34% expense is considerably lower than the 6 to 7% spent on other buildings. Inquiring the owner about this discrepancy is essential. The owner explains that the recent remodeling classified the expenditure as capital improvements led to lower repair costs, as apartments were extensively renovated within the last 18 months, resulting in minor repairs during the year. While answering this query, the owner raises additional considerations. Anticipating realistic repairs and maintenance costs for the following year, possibly around 6%, is advised. Furthermore, the vacancy during renovation suggests a reduced heating use, warranting an estimated increase in heating costs. Additionally, the accountant's advice implies potential added expenses to your tax preparation costs. Consider the remaining expense categories on the APOD form. Your management approach indicates no need for a resident superintendent, professional property manager, or janitor, or legal costs due to a standard lease. If a vacancy occurs, self-showing negates rental commissions, but the nominal amount of 175 rand should be allotted for advertising. For grass or trash removal, hiring consistent and other properties, hiring services consistent with other properties, approximately 250 rand for grass and 5 rand per week, which is 216 in total for trash, is recommended. With these adjustments, the reconstructed APOD form provides a realistic operating budget for property A, reflecting the known facts and industry trends. This offers reasonable confidence in income and expense projections. Gross schedule income 19,200. Gross operating total gross income 19,200. Less vacancy allowance of 3% 576. Gross operating income of 18,622, which is 97%. With expenses are insurance 800 4.3%, repairs are 1,117, which is 6%, taxes are 1,270, which is 6.82%, where the utilities are electricity of 280, which is 1.5%, fuel oil is 2,900, which is 15.57%, water, which is 200, 1.07%, with the total operating expenses are 6,567, which is 35.26%, with the net operating income NOI is now 12,057, 64.74. In determining the property's worthiness as an investment, further analysis on cash flows, values, and rates of return is necessary, which will be explored in upcoming chapters. However, no alarming issues have been uncovered through your examination. Having distilled raw data into realistic operating budget, you're poised to evaluate at which prices and terms this property could be a viable investment. That's it for today, guys. Anyway, I'll see you in the next chapter. Cheers.